If you walked into your bank tomorrow morning to withdraw $20,000 in cash for a roof repair, a medical procedure, a down payment on a car for your grandson, or just because you wanted the cash in a safe at home, here is what would happen in a typical process. Without your consent, before you finish signing the withdrawal slip, a required compliance review may be triggered in the bank's compliance systems. Before the teller counted the cash, your name, your address, your social security number, and the amount of the withdrawal could be recorded into a database used for regulatory reporting and information sharing with multiple government bodies. Before you reach the parking lot with the cash in your hand, a currency transaction report may be filed based on federal thresholds. And depending on how the bank's compliance team evaluates the activity, a separate suspicious activity report may also be filed. You would not be told. You would not see it. You would not have any practical way to find out. Under federal law, certain customer notices are restricted. This is not purely hypothetical. This is not limited to rare edge cases. This is a standard part of how compliance works in federally regulated banking, applied to many customer cash transactions above a specific dollar threshold under long-standing federal requirements that have been refined over time. And the document that sets the ground rules for the relationship is something you sign when you open your account, often without close review by everyday customers. In this video, I'm going to show you the sections in your bank's standard account agreement that relate to compliance, the main categories of federal reporting that may be triggered, and the general conditions that typically cause them. The true story of a 67-year-old Iowa restaurant owner named Carol, who lost $32,820 through civil asset forfeiture without a criminal charge being filed against her. A historical explanation of how banking compliance and reporting expanded over the decades. Why retirees often get disproportionately scrutinized when their transactions involve frequent cash movement. And the 5 protection moves every retiree with significant cash savings should consider putting in place this week. My name is Wasim. I am an enrolled agent federally licensed to represent taxpayers in front of the Internal Revenue Service, and I work every week with retired clients who have just received a letter from the IRS or the Financial Crimes Enforcement Network and have no idea why. A common cause is exactly what I'm about to walk you through. Let me start with the document you signed. When you opened your checking account, your savings account, or any other deposit account at a major American bank, you signed a document that is somewhere between 30 and 70 pages long, depending on the institution. You probably signed the signature card on top of the stack. The bank teller pulled the paperwork away, and you walked out with a debit card and a checkbook. The document, which is variously called the account agreement, the deposit account agreement, the account terms and conditions, or the customer agreement, is the legal contract between you and the bank that governs the account relationship for as long as the account is open. And inside that document, the bank reserves a series of legal rights that almost no customer ever realizes they granted. Right. Number 1, the right to refuse service. Every standard account agreement in the United States typically contains a clause stating that the bank may, at its discretion, refuse to process any transaction, refuse to release deposits, refuse to honor a check, and refuse to permit a withdrawal with or without explanation for any reason or for no reason at all. This is the mechanism that lets a bank tell you on any given Tuesday morning that they will not process a withdrawal today. They do not have to provide a reason. They do not have to provide a timeline. They are generally protected in making that determination. Right? Number 2, the right to close your account. The same account agreement typically contains a clause stating that the bank may close your account at any time without notice, without cause, and without obligation to provide an explanation. The bank will mail you a check for your remaining balance, and your relationship with that institution is ended. This is the mechanism that powers what is sometimes called debanking. The practice of major financial institutions closing accounts of customers whose business or political affiliations have been flagged in the bank's risk profile. You have no meaningful right of appeal. You often do not get a clear explanation. Right. Number 3, the right to file federal reports on your activity. The account agreement commonly states that the bank must comply with federal banking regulations, including the Bank Secrecy Act, the Patriot Act, and the regulations of the Financial Crimes Enforcement Network, and that the bank may file reports required or permitted by law without notifying the customer. By signing the agreement, you have authorized the bank to follow those compliance obligations. Right. Number 4. The right to hold your deposits. Under Federal Reserve Regulation CC, banks are legally permitted to hold deposits for certain periods, including up to 2 business days for local checks and longer for non-local or large checks, with additional time possible under specified circumstances. Your money can be in their building, shown in your account balance, and still be legally inaccessible to you for a period of time. Right? Number 5, the right to a protective hold for seniors based on elder financial exploitation guidance issued in 2024 and senior-focused safe banking laws passed in multiple states. Banks have legal protections that allow them to delay certain transactions on a senior customer's account for up to 72 hours when they suspect exploitation. If the bank suspects exploitation, the bank may delay without having to prove exploitation is certain. The bank typically does not need to convince you in advance. These 5 common rights are reflected inside the document every retiree signs. They are not usually hidden. They are often stated plainly in the standard contract used by banks. And the reason the bank has these rights is that reporting and compliance duties have long been built into the banking system, requiring information collection and possible sharing with federal and related agencies on many transactions. Now let me walk you through the 3 categories of federal reporting that may be relevant, the general dollar thresholds that trigger one of them, and what each report can do inside the broader banking compliance ecosystem. The first category is the Currency Transaction Report, formerly known as FinCEN Form 112. The Currency Transaction Report is generally mandatory and non-discretionary. Any cash transaction, deposit, or withdrawal that exceeds $10,000 in a single banking day must be reported. The threshold has not been adjusted for inflation since the law was passed in 1970. $10,000 in 1970 is often cited as roughly $81,000 in today's purchasing power. The filing is typically required within 15 days of the transaction, and the information is entered into a FinCEN database, cross-referenced against other compliance data, and retained for at least 5 years. The second category is the Suspicious Activity Report, formerly FinCEN Form 111. The Suspicious Activity Report is filed based on the bank's discretion when it detects suspicious activity or patterns. There is generally no minimum dollar threshold for filing. The bank is also generally restricted from informing the customer that such a report was filed. Customers who ask the bank whether a report exists may be told the bank cannot disclose it. The Suspicious Activity Report is considered one of the most powerful tools in the compliance system because it can be filed even without a specific dollar threshold when the activity appears suspicious. The third category is the designation of exempt person reporting and the structuring-related reporting, both governed by Title 31 of the United States Code Section 5324. Structuring, in general terms, refers to intentionally breaking up a transaction to stay below reporting thresholds. The maximum penalty can include up to 5 years in federal prison, plus a fine of up to $250,000 plus potential civil forfeiture of structured funds. And here is the part that is most difficult for retirees. Structuring does not necessarily require an underlying crime. The money can be fully lawful. The money can be retirement savings, home sale proceeds, insurance settlement funds, or monthly Social Security payments. If the government can prove that you intentionally split a transaction to avoid a reporting threshold, it can be treated as a federal offense even if every dollar involved is otherwise your own legal money. These 3 categories of reports help form the compliance backbone of the U.S. banking system. And once you understand how they work, you can understand the story of Carol Hinders. Carol Hinders is a 67-year-old grandmother who until 2013 owned and operated Mrs. Lady's Mexican Food, a small family restaurant in the town of Spirit Lake, Iowa, with a population of approximately 5,000 people. Carol had run the restaurant for 38 years. Her business was almost entirely cash. Her customers paid in cash. Her tip jar was filled with cash. She paid her suppliers in cash. And every 2 or 3 days when the cash piled up in her register, Carol drove the cash to the bank and deposited it into her business account. Carol's deposits, like those of many cash-heavy small businesses in America, were almost always under $10,000. They were under $10,000 because that is how much money fit comfortably in her deposit bag. They were under $10,000 because she did not want to leave the restaurant unguarded for longer than necessary. They were under $10,000 for reasonable, legitimate business reasons a small restaurant owner would have for making frequent, modest deposits. In May of 2013, two agents from the Internal Revenue Service Criminal Investigation Division walked into Mrs. Lady's Mexican Food and informed Carol that her entire bank account had been seized. The amount taken was $32,120. The reason given was that her deposit pattern, consistently under $10,000 and made multiple times per week, was viewed as consistent with structuring. There was no allegation that her money was proceeds of an actual crime. There was no allegation that her business itself was illegal. There was no allegation of tax evasion. There was no criminal charge filed against her at any time before, during, or after the seizure. Carol was told that her money had been seized under the structuring statute and that to recover it, she would have to file a civil claim, hire a lawyer at her own expense, show to a federal court that she did not intend to evade reporting requirements, and persuade a federal judge to release her funds. The burden of proof in many civil forfeiture cases is on the property owner, not on the government. The government is not always required to prove wrongdoing beyond the statute's standards. Instead, the owner may need to prove the absence of the required intent. Carol could not afford a lawyer. The seized money was her business operating capital. Without it, she could not pay her suppliers, her employees, or her rent. Mrs. Lady's Mexican Food was forced to close. Carol's case was eventually taken on a pro bono basis by the Institute for Justice, a public interest law firm focused on civil asset forfeiture defense. After more than a year of litigation and after national news coverage, the Internal Revenue Service agreed in 2014 to return her $32,820. By that point, her business was permanently closed. Her 38 years of work were gone. The federal government did not apologize, did not admit wrongdoing, and was not held legally accountable in a way that restored her losses. Carol's case is not isolated. The Institute for Justice has documented many similar civil asset forfeiture matters involving ordinary small business owners and retirees. Many of them were pursued under structuring theories, often without resulting in criminal charges. And many of these situations begin with compliance reporting generated from the customer's own banking activity, prompted by account agreement provisions and banking compliance processes. Now, let me give you the historical explanation of how this system developed. Because the compliance infrastructure I just described did not appear all at once. It was built piece by piece over several decades in response to multiple historical events. And once you see the pattern, you can recognize the logic. In 1933, shortly after taking office during the depths of the Great Depression, President Franklin Roosevelt issued Executive Order 6102, which made it a federal crime for Americans to own more than a specified amount of physical gold coins, or gold bullion. Citizens were ordered to surrender gold to Federal Reserve banks in exchange for paper dollars at a fixed price set by the government. The penalty for non-compliance included up to 10 years in federal prison and a fine of up to $10,000. The action was justified as necessary for the financial emergency and to control monetary metal held outside the system. In 1970, in response to organized crime and financial abuses, Congress passed the Bank Secrecy Act, which created mandatory reporting requirements and established the $10,000 currency transaction report threshold. In 2001, shortly after the September 11th terrorist attacks, Congress passed Title III of the USA Patriot Act, which expanded the Bank Secrecy Act framework, supported the development of modern compliance databases, required every bank to develop and maintain anti-money laundering compliance programs, and authorized broader sharing of banking information across authorized government structures. In 2024, FinCEN issued updated guidance authorizing banks to delay certain senior transactions up to 72 hours when elder financial exploitation suspicion exists, with legal protections for the bank. Regardless of whether suspicion proves correct, each of these expansions was justified at the time, on emergency or public safety grounds, and continued afterward. The cumulative result is that a federal banking compliance and reporting system monitors many meaningful transactions of consumers, with reporting obligations and limited customer notice in many cases. Now, here is why retirees can be more likely to draw scrutiny in this system. There are several reasons, and they often combine. Reason 1. Retirees may have larger, more visible cash transactions than some other age groups. Medical bills, car purchases, family gifts, home repairs, second home down payments, and inheritance-related funds can often exceed the $10,000 currency transaction report threshold. Reason 2. Retirees often have predictable, recurring income streams from Social Security, pensions, and required minimum distributions. Changes from a retiree's normal pattern may stand out more clearly to compliance software than changes in a working-age customer with more variable employment income. Reason 3. Updated 2024 Elder Financial Exploitation Guidance gives banks additional authority to delay suspected exploitation involving senior customers. Reason 4. Retirees may be more likely to want physical cash on hand for emergencies, which can create tension with reporting and intent-based rules. Reason 5. Retirees may be less likely to litigate when a bank delays access to funds or when compliance concerns arise. The system can depend on many flagged customers simply waiting out delays and not escalating quickly. In practice, if you are a retiree with significant savings in a major American bank, the compliance triggers can be calibrated to flag cash-heavy patterns more aggressively than in other demographics. And the only effective response is to put protections in place before any transaction triggers a report. Here are 5 moves every retiree should consider in order this week. Protection move number 1. Build a physical cash reserve kept outside the banking system of 2 to 4 months of essential living expenses. The reserve should be stored in a fireproof, waterproof safe in your home, in a location your spouse and a trusted contact know about. Refill it gradually with cash withdrawals of less than $1,000 at a time, taken at the same teller on the same day of the week over a period of months. This is not the same as structuring under federal law, which requires an intent to avoid reporting. Withdrawals of $1,000 do not approach the $10,000 threshold and are generally far from qualifying by amount alone. The purpose of the reserve is not to evade reporting. The purpose is to maintain access to your own money during possible banking delays you cannot reliably predict in advance. Protection move number 2. Spread your savings across multiple banks. The federal deposit insurance limit is $250,000 per depositor per bank per ownership category. Holding more than $250,000 in a single bank can create 2 risks at once. Possible loss of FDIC coverage on the excess and concentration of your assets under one set of account agreement terms that may allow the bank to freeze, hold, or close the relationship. Splitting your savings across at least 3 different banks can reduce both risks. Protection move number 3. Move long-term savings to United States Treasury securities purchased directly through TreasuryDirect.gov. Treasury securities pay competitive interest, are not held inside the commercial banking system, and cannot be frozen by a commercial bank's compliance officer. For many investors, they are among the safest dollar-denominated investments available, backed by the full faith and credit of the United States government. For retirees, the combination of safety, yield, and reduced exposure to a commercial bank's account agreement is often a key asset allocation move. Protection move number 4. Replace your primary bank with a credit union, or at minimum, open a parallel account at a credit union. Credit unions are member-owned financial cooperatives, not for profit by structure. Their compliance teams may be smaller. Their incentives to file aggressive discretionary reports may be lower. And the customer experience at the teller window can feel significantly different. Credit unions still must comply with Bank Secrecy Act and Patriot Act requirements, but the volume and style of discretionary suspicious activity reporting can differ from major commercial banks on a per-customer basis. Protection move number 5. Document every cash transaction over $5,000 in writing before the transaction occurs. Keep a spreadsheet or notebook with the date, amount, source of funds, recipient, and purpose of the transaction. The documentation does not have to be complicated. 1 page in a notebook can be enough. The documentation matters because many civil asset forfeiture cases, many structuring inquiries, and many suspicious activity report follow-ups turn on whether the customer can produce contemporaneous records explaining why the pattern looked the way it did. If you can show the reviewing agent a clear record of why each transaction happened, you have a much stronger position. If you cannot, you may be relying on an agent to accept your explanation without supporting documents, which is weaker. Now, before I close, let me tell you about a resource I built for the kind of retiree who just watched this video. My team and I assembled the 2026 Retiree Protection Checklist. It is a 42-page comprehensive guide covering the clauses in the standard account agreement you may need to understand, along with a complete protocol for setting up the 5 protection moves. I also cover the specific types of banks that may have stronger senior protection practices and specific options to consider when adjusting where you keep savings, along with commonly missed deductions retirees can lose each year. I include estate planning mistakes that cost many families significant avoidable taxes, and common Social Security and Medicare timing decisions retirees often get wrong. It is 42 pages. It is completely free. To get the checklist sent directly to you, go to marcusgraves.kit.com/checklist. Enter your email, and the full checklist will be in your inbox within a few minutes. And while we're talking about taking control of your financial life, for any retiree who handles their own tax filing, I want you to look at TaxSlayer. TaxSlayer is the software I personally recommend to clients who are comfortable filing on their own. It is typically less expensive than the major competitors you may have heard of. It handles common situations a retiree may face, including Social Security income, pension distributions, required minimum distributions, capital gains, and the 1099-K reporting requirements tied to the updated thresholds. And it is supported by a team of tax professionals you can reach if you get stuck. The link is in the description below this video, and using that link supports this channel at no additional cost to you. Let me close with the most important point I can make in this entire video. The account agreement you sign when you open your bank account is a legal contract. Every clause inside it is enforceable. Every right the bank reserved is a right you agreed to, subject to applicable law. The Bank Secrecy Act of 1970, the USA Patriot Act of 2001, and FinCEN's 2024 guidance are not rules that might affect you later. They are part of the compliance environment governing many transactions already made, many reports already required, and many flags already associated with accounts and activity. You cannot undo the account agreement. You cannot opt out of the federal banking compliance system. You cannot prevent your bank from meeting legal reporting obligations. But you can put protections in place so that if the system flags activity, your own funds are more likely to remain under your control. Keep a physical cash reserve outside the system. Spread savings across multiple banks. Place long-term funds into Treasury securities rather than only commercial bank accounts. Choose a primary banking relationship at a credit union, not a mega bank as your only option. And keep contemporaneous documentation of meaningful transactions. Carol Hinders did not have these protections. The compliance system flagged her activity, her funds were seized, her business closed, and the only reason she recovered her $32,820 was because a public interest law firm took her case for free and the press covered it. The majority of retirees who experience enforcement or hold-related outcomes do not get their money back. The federal government may keep the funds. The bank keeps the relationship. The retiree absorbs the loss. You do not have to be the next Carol. You have the information now. You have the 5 protection moves. You have the checklist. The only thing left is to act on it before the next time the system flags one of your transactions. If this video was helpful, please hit the like button, because that is one of the most important signals that tells the YouTube algorithm to show this video to more retirees who may need it. Subscribe if you have not already, because next week I am releasing a follow-up video on the 3 specific banks with the strongest senior protection practices and the 2 options every retiree should consider moving their savings toward before the end of this year. And if you know a friend, a sibling, a parent, or a neighbor over the age of 60 who has significant savings in a major American bank, send this video to them directly. The account agreement they signed is the same type you signed. The clauses inside it are similar, and the compliance system can be calibrated to flag similar cash patterns across many customers. I will see you in the next